The question is this: what do these numbers this week, what does the guidance they give mean for the health of this bull market and what has been the best start to a year in many years? Joining us now is Mark Avallone. He is president of Potomac Wealth Advisors. And Mark, we had a guest on yesterday, not to destroy the entire story that we just led into right now, who said that earnings are okay, but the Fed matters a lot more than corporate results. Would you agree with that?
Well, it depends where we are in the cycle. At certain times they do. They certainly did in Q4 when the economy was strong, but the Fed was extremely aggressive. Right now, I'm not sure what role the Fed is going to play. They've said we're going to be more on the neutral side. I don't imagine a 4, 6, or 8 month reversal versus that Q4 stance. That would be a total capitulation. I think the Fed is going to stay pretty static from here and let the work they've done shake out. The rates have risen they have that cushion that they wanted. I think the blend between where the inflation rate is and growth rate and the interest rate structure is kind of a sweet spot for them to say, what can the economy do? I don't look at the Fed as meddling right now. I think the economy and earnings are going to be the story.
If earnings come in as expected with high single-digit growth rates, is that going to be enough to justify the 17% gain in stocks that we have seen this year, Mark?
Well, I think that's the earnings expectation that this rally has been built on, that once the Fed took themselves out, we can have earnings growth. Maybe it's mid-single digits, maybe it's high single digits, and that can justify the levels we're at. My concern is that people are getting used to, investors are getting used to these good new days where we're up 20% year to date on the growth side of the ledger and thinking that we can extrapolate that out for the rest of the year. The reality is we are now back to a market valuation that is similar to where we were in Q4 of 2018. And when we get to these valuations, we need a catalyst. And I don't think we have one right now. I think we're going to have modest earnings. And you mentioned higher oil prices. We're going to start to see slight headwinds for the consumer. And I think it's going to be more of an expectations management game. Individual stocks doing well on good news, but the overall market chugging along at a slower pace.
Yeah, okay, so need I remind our audience what happened in the final month of the fourth quarter of last year? August and November were okay. December was an unmitigated disaster with one of the worst Decembers going back to the Great Depression. So do these valuation levels, Mark, need to worry us? Are we priced to perfection where if the numbers aren't good or the guidance isn't good, that the market could do what it did back in December?
Well, the valuations are similar, but the big difference is we don't have a hawkish tone from the Fed. That's why I don't think the bottom is going to fall out like we saw in December. It's more of a cautionary word. When we look at global growth rates, and the IMF are taking down growth rates in the Eurozone, even in the U.S., say, where's the global growth that's going to stimulate demand? How are earnings going to grow in line with an expanding economy? And that's where I see it more stalling as opposed to falling out. And that's why I say investors have to be realistic about returns from here on out and expect interim volatility. When you're at these levels, any bit of bad news, for instance, if the China trade talks stumble or we come out with something surprising, we don't have a lot of cushion. And those are more of the jolts that I'm worried about.
Is this the gain for the year? Or, I mean, I hate that it's April 23rd, for Pete's sakes. I hate even saying this, but are the gains for the year on a macro level? Individual stocks are going to do what they want. Right. On a macro level, have the gains for the year been put in, Mark?
I think the majority of the gains have been put into stocks. And I think that if earnings are strong, we could see it chugging a little higher, but I don't see us up 25, 30% for the year. So, of course, mathematically, most of the gains have been baked into stocks. And that's why I keep going back to managing expectations and expecting interim volatility, but I don't think it's going to fall through the floor.
So how do we make money for the remaining, 8 months of the year, Mark?
I think you continue to invest. What's gotten us here, certainly the growth side and tech names continue to astound. And I think it's because you have top line, you have real growth there. We'd love to see financials participate. We've talked about that here many times. I think the spreads have been a real problem for banks. I think their cost of funds is creeping up with a lot of competition from internet banks and elsewhere, and I don't think that's been fully discovered. I think that's what some of the earnings compression is. But if they can break through and get some better trading, better M&A, because we see a lot of M&A this year. I think if financials can come up and surface as earnings growers, that could be a real boost for the market.